Hello everyone, this is the Impact Factor, and today I'm going to tell you why I'm short Opendoor Technologies, ticker symbol OPEN. Now, the first problem with Opendoor are the financials. So the company is simply overpriced. At this point, it's not even a matter of whether it's a good company, whether it's a bad company, whether the CEO should be worth 5 billion upon just coming in, which in my opinion, he shouldn't. But the point is, the company is just expensive. So right after earnings, the stock went to $5.5. And with 958 million shares outstanding, that gives you a market cap of 5.3 billion. And that's just a ridiculous price for a company like Opendoor. You look at the balance sheet, and the balance sheet is all right, but it's all right at your expense if you're the shareholder. And I'm going to get to that in a second. The company has about a 1.3 billion in cash and a 1.3 billion position in debt, which is a significant reduction from what Open is used to. So that is an EV of about 5.3 billion. Opendoor also went public in 2020 via a SPAC. It was merged with Social Capital something. This is an important point to me because I always see that as a kind of a weakness for companies. SPACs were a big thing during COVID, during the pandemic, and it kind of signals a broken business to me. If a company didn't go public through a regular IPO or a secondary offering, the question is why? And with a case of a company like Opendoor, it's obvious to me that there was no sufficient interest in the company. Here, it was because I think the business is just broken. It's just a bad business. The idea is just not the greatest. It's not there. Now, I think at its core, Opendoor is a broken business, and I think it has no place in reality. Why? Well, because the idea is that people are going to be selling homes faster. That is going to become sort of an eBay for houses, sort of a Vinted if you live in Europe. Buying a house is just not as simple as buying something from Amazon, as ordering a book, or as even buying a car. Buying or selling a house should take longer because it's much more complicated. Moving is a complicated process. And I think the core idea is just broken. So Opendoor comes in, buys your house, and they pay all cash for it, and they finance it with debt. The problem is later on, if the house is a failure, if they fail to sell it as fast as possible, then they have to pay the interest on the house, which you can see here in the interest expense line in the P&L. It has almost a perfect correlation with the number of homes held in the inventory. And this is kind of a bad place for them to be, because either you don't buy houses and then you have no business, or you do buy the houses, but if you fail to perfectly pitch every house and you have anything left over, then you're paying interest on it. It's kind of a prisoner's dilemma. If you do it, you're exposing yourself to all kinds of risks, and if you don't do it, you're also exposing yourself to just plain old bankruptcy. Now, Opendoor is a company that never made a profit by any metric. I mean by this that net income has never been positive, neither has operating income, and best part is, which is particularly difficult to understand and strange for a tech company, for a software company, is the gross margin is just unbelievably low. At 4% in 2025, 8% in 2024, it circulates around that 7, 8, 9%. That is a ridiculously low gross margin for a tech company. If you look at cash flow from operations, the only years of positive cash flow that they had came from changes in working capital, which is not a viable way of making money because those are just essentially carryovers from the past year. So if you look at cash flow from operations before changes in working capital, it's negative, and it's always negative. And that is just a sign of a bad business. So essentially, any year that you see positive cash flow, like here, it's just a carryover from the previous year. If you sum all the previous cash flows, it's still a negative of about 1.5 billion. That is a cash burn of 1.5 billion for the past 5 years of the company. CapEx is low, of course, because this is a tech company. There is nothing to spend it on, but it doesn't matter. You get a negative free cash flow just because the company is not making money from operations. The only way for companies like these to make money is by tax exemptions or interest income, but that's situational. That's not a real business. It's not a business to get tax exemptions. Another thing that I invite you to look at is the shares outstanding. So the company went public in 2020, and instantaneously, the year they went public, they started printing shares. From 109 million shares, just a year later, it was 593 million. And ever since, it was going up. Right now, 5 years later, we began 2020, we on average had 110 million, 109 million shares, and now we have 767 million. That is a crazy increase. Just last quarter, quarter over quarter, shares outstanding went from 742 million to 870. And it's even better because if you look at the shares reported at the end of the quarter, because the result you see here in the P&L is just the average of the shares outstanding. So if at the end of the quarter, they're going to print out a ton of shares, it will be kind of diluted by the average. But if you can compare 958 million at the end of Q4 25 and you divide it by 773 million at the end of Q3, you will see that the company essentially diluted you by 24%. Think about it. Your ownership, if you held the shares for just one quarter, your ownership of this company went down by 25%. If the market cap was neutral, your share price would have gone down by 25%. That's hilarious. This is why this company is a great short. And this is the only way they make money. This is the only way and the only reason why their cash position on the balance sheet is going up. It's because they're printing stocks and they're selling them. You can see it in the paid-in capital part of the balance sheet, which is going up and has only ever gone up since the company went public. The guy that came in, Kaz Neyatyan, I like him. I listened to his earnings call, the last one. I liked what he said, but he was pretending as if Opendoor is a new company. That's actually what he said. I don't think that's true. It would be a new company if he just left. If he just left Shopify and started a new company, then it would be a new company. But this is the same old company with just plainly a shitty business. And, in the management struggle against a shitty business, if you have the greatest management ever, I will bet on the business to win with its shittiness. Now, here's the P&L for the past 7 years, and I'm really not the biggest fan of forecasting, but I will do it for the purpose of an example here. In the case of an hugely, I think, overvalued company like this, I like to forecast sort of a best case scenario and see what price the stock reflects for it in the future, sort of reverse engineer the price. So if you look at it, in the past, Opendoor has been losing an average of 600 million every year on net income. I know the CEO wants to break the company even, bring the company to break even by the end of 2026 on a 12-month forward-looking basis. So this means we can assume that they're still going to lose money in 2026. How much? Well, we can't really be sure, but say they lose about 200 million. Say Kaz is a fantastic entrepreneur, a fantastic CEO, and his team really does make a difference, and they only lose about 1/3 of what the company has been losing for the past 7 months. Then they're going to break even in 2027, so this will be a net zero year. And say a year after that, they generate 100 million in profit. That's going to be 100 million for 2028. That's a 2% profit margin for them. Keep in mind here that I'm assuming that the revenue keeps growing at a 2% a year. So this is on a real basis kind of neutral, but this doesn't have to be. Where's the contract saying that this has to be the case? What if real estate prices start going down? What if Trump deports enough people for real estate prices to actually go down? How is Opendoor going to deal with deflation? And that is a real problem for a company like this. If you buy a house and by the time you sell it, the price has gone down by 3%, then on a $1 million house, you just lost $30,000. That's a lot of money. and that's going to cut into their profit margins. But let's say nothing changes for the worse. So say after this, for the next 2 years, they will keep doubling their profit. And after that, they're going to keep growing at a 1% growth rate, maybe even 2 or 3 or 4. At 4% growth rate after that, you still have a big cushion of upside on the below, so downside. I put a 10% discount rate here just because I think this is a company with no real moat. What is the moat of Opendoor? I can't think of any. How is it different from Zillow? How is it different from just calling somebody and buying their house after seeing their advertisement on Facebook? Sure, it's better if you're selling, but is it really? There's a tons of different real estate agents that you can just call up to sell your house. And what if people don't really want to sell the money instantly? Those are all real risks for this company. And keep in mind, we're looking at the best case scenario here. What is much more real, I think, is that by the time the break even of the next year comes, this company, the stock is going to go down by at least 50% just because people will get bored. The CEO is great, sure. I like him, and I think he's targeting the right things. He was talking about increasing the selling speed of the houses, which means that they're going to spend less money on the interest. He was talking about using AI to price assets. I did hear AI being thrown around as sort of the key magical word. The only thing that was lacking was quantum, nuclear, robot, superpower, cosmos, Mars AI. AI is kind of being used as a magical word that CEOs use nowadays to explain anything to make people believe that this time it's different. I just don't think it is. I don't think an AI is going to be much, much better than experts at buying houses and valuing them. A little better, sure, but enough to make a significant difference, or better yet, enough to make a difference of 5 billion? I don't think so. Keep in mind, half a year ago, this company was trading at 400 million. And now, all of a sudden, a new guy comes in, brings over his friends, and it's supposed to be worth 5 billion, or at its peak, 8 billion? That's just crazy. That's just stupid. If these guys, if they just founded a different company with a better idea, maybe it could be worth a couple $100 million on the start. But billions? That's a lot of money. And I think that's a lot of money for the taking.